Hey, what's going on, everyone? Christopher here. And today I'm going to talk about something that I get asked a lot from my clients, my friends, and my family. And that's what type of insurance should I be getting? And the answer is a really complex answer. It really just depends on um, what you're using the insurance for, what's the purpose behind it, and how much you actually need. So, the first thing I'm going to talk about is the types of insurance. Okay. So, the first type that everyone has heard about is called term insurance. And that basically means it lasts for a certain term, a certain period of time. Okay. So, you got 10, 20, 30-year terms, but then you also have terms that are on a year to year basis. And depending on how long that term is, that's how long that contract goes for. And at the end of the term, if you wish to get another term policy, you will then be charged based on your new age. Okay. So the term is based off the age you are to the age you're going to. And that new term will be based off the same. Okay. So that's the first one. The second one we're going to talk about is a whole life policy. Okay. And a whole life policy lasts your whole life. Okay. Your whole life policies can be used in a couple of different ways. The first way a whole life policy can be used is the traditional, just to pay for your funeral and final expenses. And then it can also be used for infinite banking, which I will talk about a little bit more at the end of this video. Okay. And then the third type of insurance, which is called universal life. And what universal life means, it basically means that you're going to get some type of money back and it's going to be based off more of a year to year basis. So those are the three types of insurances that there are. But then there's different little caveats with each one and ways that you can use them for different things. Okay. So the first one, as we were talking about, is a term life insurance policy. Okay. Term policies are generally cheaper because they're more affordable for younger, healthier people. Okay. So you can get, $100,000 term policy for, uh, $60, $70 a month. And that's just a term policy. But then you can add on other benefits to it, like living benefits. And I highly suggest that if you do get a term policy, make sure you're getting something with living benefits because that's going to really help you not just be giving away your money, because it has more opportunity to pay out. I believe 97% of term policies never pay out. And then it goes down to about 80 some percent once they add on the living benefits. Now, the third thing that you could add on there, or should I say the second thing you can add on there, is what's called a cashback option. Okay. So this makes it a little bit more of a universal life policy. But if you're young, you're healthy, and you can qualify for it, I would definitely make sure that you're getting a term policy with cashback. Okay. So to go a little bit deeper into that, the cashback option usually is 25 to 30 years. Sometimes you can do a 20-year cashback option. But what it means is, say I'm paying $100 a month for 30 years. At the end of that 30 years, if I don't get sick, I don't use that accelerated benefit, which means that living benefit. If I don't use the living benefit and I don't die, I get back every cent that I put into that policy. Okay. And there's some companies that do 100%, which that's what I would suggest. And then there's other companies that do something like 75%. Either way, you're getting something back versus spending all this money to the insurance company for them to keep. Okay. All right. So now we're moving into the second type of policy, and that's that whole life policy. Okay. So most people that get the whole life policy are using it for the funeral and final expense. Okay, just means simply that they want to pay for their funeral. They just want to make sure that their family is not paying for that out of pocket. Okay, versus term when you're wanting to leave a whole lot of money behind, on not only for the funeral, but to make sure like homes are paid off. Cars are paid off, and that your family has that income replacement. Okay, so whole life is just covering that funeral and final expense. So we see typically people over the age of 60 looking to make sure that the funeral is covered. Sometimes they want to leave a little bit extra. So these policies are rather small, 20, 30 $1,000 all the way up to maybe $50,000, just something to pay for the funeral and final expense and maybe just leave a couple $1,000 behind for their loved ones. Okay. The other way that you can use a whole life policy is to use it as infinite banking. And what just happens with this is you're using a lower death benefit, that lower face value, so 60, $70,000, but it's going to accumulate cash. And when you're accumulating the cash, it's going to accumulate pretty high versus your traditional whole life policy. Okay. We like to call this a high early cash value whole life policy. Okay. And the reason that this is beneficial is it's a great way to pay down debt. It's a great way to store the money to purchase more assets. And the way this whole life infinite banking system works is you put in, say, $3,000 a year, you can borrow up to about 2,800 of that money. So what happens is the bigger policies you get, the more money you're putting into them, the more money you have available quicker. Okay. So what could happen is, say you wanted to buy an apartment complex, you needed $100,000. Well, you've put in maybe $140,000, and now you can take out that 100 grand, buy the apartment complex, and then pay yourself back relatively cheap, 1 to 2%. Okay. But the bonus of this item is you've got $140,000 in this account. You're gaining up to about 5% interest on that $140,000, even though you took a loan of $100,000, which traditionally, if you just had that money sitting in the bank and you needed $100,000, you had $140,000 in the bank, and you took $100,000 out of that 140, now you only have $40,000 left in the bank, and you're earning 0.01% interest on that $40,000. Versus where if you do it this way, you're still gaining about 5% on the entire amount of money, even though you've already took a loan on it. So that's why it's a great tool to build wealth, and that's what we like to use that version for. Okay. The third one is universal life. And universal life is very special because it allows you to grow capital. And when I speak of capital, I mean money. And it's going to be at a lower rate than maybe the stock market, but you're not going to have to deal with uh, the market going down. So what I'm talking about now is an IUL. It's a trendy term that people are now talking more about. But an IUL is a way for you to put money into your account monthly, yearly, annually. It's different ways you can fund this account. Okay. But once you're funding this account, you're going to be able to participate in the stock market. Now, you're not in the stock market, meaning if the stock market goes up 20 percent, you're not going to get 20%. Okay. Usually an IUL is somewhere around, 10% ceiling, but there's zero floor. So, you say you've made 10% the last 2 years, and then the market goes down and people are losing, 15%. Well, that 15% is not going to be a loss for you because you were locked in at that 10. So you're not going to lose any money in the down years. So it's a great way to make sure you're just steadily growing that account. And a lot of people use this for retirement. And it's a great tool because as you're funding it, you're going to be gaining interest on it. And then once you reach that point of retirement, you can actually take payments from this account and you won't be taxed on them. So it's a great way to get tax-free income, especially once you hit retirement. Okay. So those are the traditional types of life insurance. Deciding which one is going to be best for you, it really depends on your circumstances. But here is just kind of breakdown of what I would recommend depending on your situation. Okay. So if you're young and you're healthy and you have children, okay, a term policy with cash back, if you can qualify, would be my number one go to. And the reason that I would say this would be my number one go to is because, yes, you might be, uh, on your way to making a lot of money in your future. That's a possibility. Okay. But say something happens to you tomorrow. Well, then your plans got cut short. So now if you have, a $300,000, $400,000 life insurance policy on yourself with cash back, that means that that money is automatically going to be given to your family if you die sooner rather than later. Okay. But say you live your 30 years, you get all that money back, and then you can repurpose that money and put it into a different type of a policy and use that uh that cash a different way. So you're basically just locking in your health now, and you're betting, you're just hedging is a better word. You're hedging on whether or not you make it to your goals. If you don't make it to your goals, your family is taken care of. If you make it to your goals, you get all your money back. That's basically what you're doing with this policy. Okay. Now, the second one, it really just depends on where you're at and what you're looking to do. Okay. Um, the whole life policy with the whole life policy that's high early cash value, that would be my next recommendation if you are already contributing to a 401k. Okay. Or if you know that you are ready to start investing, this one would be my ideal recommendation. The reason that I recommend this is because depending on how you're setting it up, you are able to put this money into a policy, gain around 5% interest, pull the money out while still gaining interest, and then you're able to purchase that asset that's going to go right back into that insurance policy and pay yourself back. And then you just rinse and repeat. Okay. I have a client who is doing car washes. Okay. The car wash cash flows about uh $40,000 a month. Okay. It's automated car wash. It's in a high traffic area. So they get a lot of business. Okay. So to set up the car wash, it takes about 100 grand. I have a client that comes in, gets a loan on their policy, takes 100 grand, gets the car wash all set up. And then as that money is coming in, he's paying, the maintenance and all of that cash flow goes back into the insurance policy, takes a little bit for himself. And then once that money is refilled back into the account, they will take another loan and do the same thing. So the whole time that they're taking these loans, they're still getting interest on the money that's in the account. Even though they've taken the loan for 100 grand, they're still able to get, interest on that money. So it still grows. Okay. Now, if you are not contributing to a 401k and you don't really know how you're going to save for retirement, and IUL would be my next best option because you can do similar things as you can with the whole life policy. It just has a better chance to grow the capital. So if you're depositing $100 a month in this policy and you're averaging 6% a year, you know, now that account is going to be able to grow. You can still take a loan from the policy and do the same thing and then pay yourself back. So that's another great option, especially if you're not contributing to a 401k. So the last thing that I really want to talk about is I get this one a lot as well. Well, I'm already contributing to a 401k. Should I stop contributing to my 401k? And should I do an IUL instead? And this one, it really just depends. Once again, I'm sorry that some of these answers are not straightforward, but it really depends on your situation. Okay. So I always like to say the best type of money is free money. The next type of money, best money, is tax free money. And then after that, it's just, taxed money. Okay. So if you're contributing to a 401k and say they're giving you 5%, I would go ahead and contribute the 5% because they're matching you dollar for dollar. But if they're not matching you, then I would strongly say that maybe you lower the amount that you're putting into the 401k and do an IUL. Okay. And the reason for this is because if they're not matching you and giving you free money, then you're just putting money that you cannot use into the 401k. Okay. Whereas if you were putting it into an IUL, you would be able to access this money if something comes up, but you also will not lose when the market goes down. And that is something that I strongly recommend, especially for some of the older clients that are nearing retirement. Anybody who is over 59 and a half, they can start utilizing this option. Okay. So once you get closer to retirement, you don't want to be taking risk with your retirement money. And IUL is a great way to mitigate those risks. So if I was someone who is young, like I said, I would go term with cash back if any type of way you can get that. Then I would move into the IUL or the whole life policy. Now, I'm going to go ahead and say this. The IUL and the whole life policy that has cash value, high early cash value, excuse me, those are going to be policies. All of those are going to be policies that are going to be harder to qualify for because they want young, healthy people. Okay. So, high early cash value, whole life policy, IUL, and term policies are all for healthier individuals. Okay. So I hope that this video has helped you get a little bit more understanding of what the insurance policies are made for, what the type of insurance policies are, and how you should kind of be preparing yourself for which kind of policy you would like to get. If you have any questions, you can reach me at 540-257-3268. You can message me at the real Christopher C. Logan on Instagram and Facebook. As always, I hope that you all have a wonderful, blessed day and a massive week. Peace.